Current market situation, like running on a treadmill, getting tired, and not going anywhere. Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click show more for additional information, links to articles, etc. on today's video. And if you're looking for a different opinion on Wall Street and Big TV, please do consider subscribing to our channel. So last week, can earnings save the markets? Well, so far, 72% of companies have beaten sales estimates for Q1, better than the 5-year average of 57%. Pretty strong. Next up, S&P earnings, 18.3% up for Q1, highest growth since Q1 2011. But last week, we didn't go really anywhere. And I think the issue is what I've been talking about, which you don't see on the big TV networks, is this chart right here. The blue in the background, GAAP earnings, generally accepted accounting principle. You see that blue line going up. At the bottom, the S&P for the last few years up 29%, but earnings growth just 3.7. So the problem is, my opinion, the tax cuts, etc., have already been baked into this market. That's why we're not seeing it break out despite good numbers. So let's get to the numbers week ending 4/20. Across the board, NASDAQ up and smalls once again continue to show some life, but Dow, S&P, and mid, not so much, pretty much flat year to date. So let's go to the big charts. So first up, I have a 5-day chart. You can kind of see the ebbs and flow of the market. This is a 15-minute chart. Had a really strong first few days, not so much the next 2 days. Friday, really not a good day based on a couple factors, but somebody came out and did not downgrade a well-known stock, but moved its price target down just $3. And that really moved the markets last week. Can't really say who that company is. Yes, so year to date, here's my chart I've been showing for quite some time. Let's start at the bottom. VIX volatility above 16. Again, keep in mind, we've never, ever, for real, been in a bear market and the the VIX is below 16. So we continue to meander along that line. Next up, momentum, MACD. Momentum, we had that positive crossover. So in the short term, yeah, we saw that move at the beginning of the week and kind of button hooked by the end of the week. So although we see that, our signal for the short term did go positive because of some other factors, and I'll get to that. First, RSI, relative strength. Have Michelle zoom in, like I've said. We cannot sustain above 50. That tells you not a lot of strength in the market right now. So the meat of the chart, I've talked about a couple big points here. Moving averages, I've highlighted in blue. 20-day, 50-day, and I actually added the 100-day up there as well. But last week I said, hey, if we break 20 and 50, I'm going to deploy some more capital because we started the week at neutral. I did, in fact, do that. But of course, we saw the move back. But despite all that, we're still, like I said, our short-term signal is positive right now. But, and this is a big one, that 20-day, wow, we can, real big-time resistance, trying to get above it. What it was once resistance is now support. And you can see it, we broke through. I think the algorithms kicked in late on Friday and pushed it just above its 50-day moving average. Next up, our weekly midterm view. Yes, we're still in that bullish uptrend, but we still have that negative crossover there on the bottom on 2 confirmations. So this is why our midterm is still negative. So we're still like in a 60-40 portfolio, 60 equities, 40 bonds. We're about 50% in equities right now. I kept a little bit off until we really do get a true direction of this market. Midterm signals, negative. Next up, long-term monthly view. As you can see, bull market's still much intact there from a long-term perspective. So here is why we are still in a positive mode. So we're pretty much neutral right now because you have two positives and one negatives. But overall, not really going anywhere, are we right now? Kind of stuck in that treadmill. Market breadth, again, not a lot of movement last week. Here's your 200-day moving average. So companies above or below the 200-day moving average. Above 60 is bullish, and the only one there right now is smalls, believe it or not. So again, not much going on there. Shorter term view, I go back to 15, 16, which was the last meaningful correction. And again, as you can see, kind of meandering along here on the short term, companies are above or below the 50-day moving average. And you can see 50% for the S&P. NASDAQ just 41%, 52% for mids and smalls. Again here, the only above. Let's take a quick look at the international view. Not too pretty here, right? So you've got Germany still down but up last week. France was up last week, went positive. China, yikes. Here's a quick image here from our friends at Hedgeye, right? It's gone from Shanghai to Shanglo. Wow, China's really having a tough time. Japan down last week. Emerging markets as a whole, okay, is just barely in the positive. Let's get to the sectors. Okay, so here, this represents 76% of the S&P. You've got tech, which is the biggest piece, 25%. So again, as tech goes, that's how the S&P goes. Up year to date. Financials were up last week, but down year to date. Health up, but just slightly down. Consumer discretion still up, obviously the strongest sector. And industrials up last week and went positive. So there, not so much a bad sign. Now overall, bringing this together, U.S. equities, 8 of 11 are in an uptrend. So now as a group, we are in fact in an uptrend, which is what drove us to the short-term signal going positive. International, only 25 of 53 in an uptrend. So as a group, they are in a downtrend combined. So next up, what is on my radar? First up, something new, a little bit different. Semiconductors, a lot of talk here. Obviously been driven by a couple big names, but going sideways here for quite some time. Take a look at it here. I've added a couple things, 20 and 50-day moving average. Had a crossover there, negative. So short term, doesn't look great. At the bottom, momentum, MACD. See the crossover there and pointing down a relative strength. So not good, but obviously this has been a very strong sector, as you see before last year how it drove up. So continue to watch this, and if we have an opportunity, we'll let you know. Next is gold. Talk about gold because a lot of things are happening right now, but nothing really. Have not added gold. I know that gold sort of was in an uptrend there, stopped, but as you can see, sideways, we have our movement there. So really at this point, I am still not in gold. I have a video on gold. It tells you when to get in. Now is not the time. So next up, Treasury yields. Big talk last week. We went down to a big time low of 0.41. Now we ended the week where we started at 0.50. But the big talk, and you can see it there, right? Obviously, 2 years been going up. That's why yield spreads have gone down. Big move last week on the 10 and 30 year. That is not a good thing, okay? And why is that happening? A combination of things. Obviously, we know about the Fed raising rates, but oil prices has been helping drive prices up. That's not a good thing, right? Yields up, price down, okay? We hit a high, a 2-year high or 3-year high, actually on your 10-year. 2.9796 range this morning, almost ready to go above 3. Not that it's a big deal, it's more of an emotional deal in the market. So concerned about that, and you can see it here, right? You can see the breakout there on the 10-year, and a little bit concerning because that can move the market. So what keeps me up at night? So first up, great follow on Twitter at OddStats. OddStats, great information. Here he talks about, in this chart, a lot going on here, but you have the S&P, okay, and then you have periods where the average drawdown, okay, over the next trading days, in this particular case, after we have rising unemployment, okay? So when you see that, generally the market has been bad, because if you look here, all right, again, so those red spots, we've had a 4-week raising average of those applying for uninsurance. We have not had that for quite some time, and you can see the impact, so we're going to continue to watch that. Next up, article, U.S. pension fund collapse isn't a distant prospect. It could come in 5 years. Folks, this is a big, big story. I have a link to the article below. Take a look. Also have a really cool image here from visualcapitalist.com. Really neat. It shows you across the world. This is a big issue. A lot of these pension funds are not going to be able to meet their obligations. And that's an issue because most of their models are set at 7 to 10%. And you look at the long term, you know, we've really been averaging 3 to 3.5% since 2000. Okay, so big issue there. Next up, the only, you know, you want to stand out? This is not a chart you want to stand out on. U.S. growth debt to GDP. Not good over the next 5 years. Not good at all. I mean, our debt situation is bad. Let's take a live look here at, and I have a link to this down below, but this is a great place to take a look. Maybe don't look at it often because it'll depress you. The U.S. Debt Clock Org. It gives you all kinds of information, but take a look at our debt. Spinning that quickly over $21 trillion, okay? That is a big issue. Wrapping things up, fear and greed. We are at 38 a week ago, 23. We went from extreme to just fear. Information on how we get those numbers. Our indicators, once again, 2 of 3 are positive. Short-term, long-term, mid-term continues to be negative, so we're still not 100% in equities. So as always, if you found this video of value, please do consider subscribing. Thank you so much for watching. This is Michael Loftus for Wealth and Wisdom TV.